Welcome back to our special show, Morgan Stanley's Worldview. This show comes to you from the sidelines of the Morgan Stanley India Investment Conference. We have been speaking with Ridham Desai, the Chief India Strategist for the company. Well, Anuj, I'm keen to ask you questions. Anuj?
Ridham, you spoke about this being a 2004 kind of scenario. Let me be a devil's advocate, and in that case, let me be a bear's advocate. We heard all this argument in 2008 as well, that there's enough liquidity and the market is just going to keep moving, and we saw what happened after that. Do you think there's a bit of a risk right now that with so much complacency around, you look at the volatility index both in US and in India at historic lows, do you think there's a bit of a risk that we could have a significant correction from here on?
So Anuj, you're shifting the debate from the medium term to the short run, and I think in the short run there are factors to worry about. Clearly, depressed volatility is a reflection of market sentiment, which is quite rich. And as I said at the outset, when you're making a call on the market, when valuations are middling, the only tools you have is your assessment of the growth cycle and where sentiment is. And I do think that sentiment is quite rich. I'm looking for the trigger which will cause the market to correct. And I think the trigger actually could be GST. Now, we just completed a comprehensive survey of India's micro and small manufacturing and services companies. See, these are not your typical listed entities. The listed entities actually all get classified as large companies. India has 9 million firms. We're talking about the tail end of these firms, and that's 99% of India's enterprise universe. Our survey shows that almost half of these guys are not prepared for GST launch on 1st July. In fact, 90% of them have expressed desire for training, and we're about less than a month away. So there is a possibility that as GST gets launched on 1st July, we face some amount of disruption in terms of growth. Now, see, the market can react to this in two ways. One is the market can say that, this is fine, we know this is temporary, GST is a great long-term reform, and this disruption will go away in a quarter or two, and therefore let's move on. And nothing happens except that the VIX index climbs up and realized vols climb up. But the index actually doesn't do anything much. However, if this is combined with a global event, because mind you, a large part of India's bull market at the moment is also driven by global factors. It's not just local thing which is happening here. We have to remember that Europe, US, Japan, emerging markets, all of them are going up. So if there's a global event of some sort, which I can't actually predict here, and it gets combined with some disruption on GST, then you could get a drawdown on the Nifty, which could be in the 5 to 10% zone. So I don't think we can rule that out. I think it is for somebody who is trying to trade this market and who's not looking at it from a 3 to 5 year perspective, I think they can wait on the sidelines. It's not yet time to short the market, I think. I think shorting the market may be a little bit too risky because the time frames really shrink there. But it may not be a bad thing to just wait on the sidelines and, you will get your moment. We got a great moment in December. The only problem for retail investors is that when that moment comes,
they don't buy.
They will not feel like investing. Because nobody was wanting to put money to work in December. We were discussing this on 2nd of December, I think, that demon will be forgotten in a couple of months. And now is the time for people to put money to work. But that's always the most difficult moment to put money to work. GST is very different from demon. I classify demon as an unknown unknown. GST is a known unknown.
That's exactly what I'm saying. Won't everyone think that way? That, if this did not give you a dip even for demon, will this really give you a dip in GST? So even this dip, are you anticipating?
No, so there was
We're changing roles. He's playing bear and I'm playing bull.
No, there was a serious dip in demon. Let's not forget that. We had a 1,400 point dip in the Nifty, and it looked very bleak in December. And growth forecasts were being cut, and people got quite concerned. We may not get a similar type of thing on GST because of this difference, which is that GST is a known unknown. But let's not forget it. GST is uncertainty. See, I contrast risk and uncertainty in this fashion, which is risk is something that can be quantified. Uncertainty is something that cannot be quantified. And I'm struggling to quantify GST, both in upside as well as downside terms. I mean, imagine the lift that GST is going to provide to corporate profitability over the next 3 to 4 years. But if you ask me to quantify what will be the inventory gains, what will be the warehousing cost gains, what will be the freight cost gain, what will be the input credit cost gains, I have no idea. I cannot even start with a number. So that is the problem with GST, is that it falls into the bucket of uncertainty. So if it is combined with a global event, then I think you could get a bit of a drawdown in the Nifty. So that's for people with a 3 to 4 month view. I think it may pay to be on the sidelines for a while. And especially in mid and large, small caps. I think that's where the risk is actually greater than and large caps. And we saw, last week, for example, or the week before, when there was a little bit of a correction, how mid and small caps corrected. That was bid, because still, even today, there's a bid on the screen. That's liquidity, right? But that bid can go away if even the markets get a bit nervous about these impending events.
Only 2 weeks back, Rakesh actually, talked about your report of $400 to $500 billion of domestic. In fact, he feels it'll be your report is very conservative, and there will be much more flows than what the street is expecting. So probably that's where everybody will go wrong in terms of how to map the domestic flows. Is what even Rakesh had a view when we spoke to him 2 weeks back. One question, Ridham. I had 5 questions for you from your report. You've replied 4 of them about valuations, exuberance, sentiment. How should one participate in this market now, given that the opportunities are quite scant?
Opportunities are quite?
Are quite limited because of
No, I don't agree with that. Why are we saying opportunities are limited?
No, I'm saying, given that from a bottom up
See, I'll tell you why opportunities appear limited is because most of us tend to get anchored to the winners of the past 3-4 years. And a lot of those winners trade at valuations which do not warrant further investments. But if you start shifting your attention to a host of companies and stocks that have actually not participated, I think there's enough juice in this market. So I don't think the opportunities are limited. Certainly not. So, it is reflected in our recent upgrades.
Sure.
I mean, there are NBFCs that trade at 2 times book.
Okay, let me just
People don't want to buy those stocks because they are worried that they trade at 2 times book and not 6 times book. But I think you have to shift your attention when the valuation risks are as disparate as 2 and 6.
You have a 24,000 bear case.
Yeah.
Why? What might lead to that?
So, Latha, I think it's a very good point you make, and I think I should use this opportunity to explain that there are 2 purposes served by index targets. One is to highlight the range of outcomes, which could be enormous over a 12-month period. In fact, over any time frame, even over a 3-month period. So the range is pretty wide, and usually it is wide because a lot of unknowns are there which we cannot actually foresee. The second is that targets actually provide some semblance of discipline. Okay, so they're not to be viewed as levels at which I think the index is going to go, but more as levels which instill some discipline about how I think about the market.
Okay.
So those are the purposes that index targets serve. So there are things that can go wrong. Things could go wrong with GST implementation. Things could go wrong with India's macro, and that demand may not recover as we are forecasting. Things could go wrong globally. So I think there are enough things that can go wrong which could cause the market to go down. We're attaching a 20% probability to the 24,000 scenario, which is not an irrelevant probability, but it's not irrelevant probability, but it is on the lower side compared to our base case and bull case. Yeah.
Fair enough, Anuj. Yeah.
Okay.
Also, just that we have rolled our index target, so now we have a new target, which is for June 18, which is 34,000, which says that there is likely 10% upside to the index. And this is very much in contrast to where I was in December, when I was far more bullish with a much bigger upside to the market. So I do think that returns are likely moderating over the next few months.
Ridham, a couple of points. Last time we invited your pharma and real estate analyst. These were 2 sectors where you had sort of contra longs. Real estate has worked beautifully for you. Pharma has not. Thoughts on these 2 spaces?
Yeah, so we have given up on pharma since then, so a while back actually. So we are underweight on pharma. I think there are structural problems there which don't go away very easily, and I think the valuations are still rich. In contrast, we actually like IT, where also there are structural problems, but the valuations are more attractive. So between pharma and IT, my preference to IT shifted at the start of the year. So we made that shift actually, but even IT has not worked out. Both pharma and IT have gone down. Pharma has probably gone down a bit more than IT, but even IT is down. So it has not worked out, the contra bet, and I'm waiting for it to turn. Let's see how much it tests my patience and if I give up. But for now, I think IT represents good valuation risk. You know, for those who are a bit more technically minded, I could highlight the fact that the correlations between IT sector and the index are running at 2 standard deviation below average and in negative territory, which means that if the market goes down, IT could likely go up. So it provides you a good hedge if you don't have other means of hedging yourself against a risk. But you know, I have to admit that neither of them have actually worked quite well for us.
Okay, you looked for space. You said that you will look for spaces where valuation is still not rich, and you're giving us one. Thank you very much, Ridham Desai, for spending time with us. What we will remember is 34,000, your base case by June, and 30,000 Nifty in 5 years.
Next 5 years.
That's what we will remember.
That's the headline for us.
Ridham, thank you very much for joining us on this special show, Morgan Stanley's Worldview.